Hello and welcome everyone to this important video. And today we are going to dive deep into Gary Black's fallacy. As you probably heard, Gary Black, who is the future fund manager, that's the name of his fund, just decided last week, imagine that 2 weeks before a robo-taxi launch of Tesla, to sell all his Tesla holdings. And he posted on X about why he did that. Today we are going to jump right into that and ask the question, why did Gary decide to do that? Read his post, and then I will comment on it and use a model, an actual financial model, to look into the actual future cash flows as I see them of Tesla, and then see what thinking errors Gary might have committed here. So here is the famous Gary Black post, and as you can see, that is from May 31st, so from Saturday. And here's what Gary writes. Let me read it to you. Tesla now trades at a forward PE of 100x. Okay. In the history of the stock market, we can't find a single $1 trillion market cap company that traded at a forward PE of 100x. We even asked Grok with no success. Well, guess what, Gary? There are not many $1 trillion market cap companies, and this is a very new phenomenon in very recent years that anyone has over $1 trillion. So welcome to the future. Why not? The long-term growth rate needed to justify a 180x PE would cause Tesla market cap to be bigger than Apple and Microsoft, which seems insane since both have huge TAMs, unassailable brands, and highly predictable future cash flow streams. Okay, wait a moment. This is already starting to contradict each other. So Gary says, in order to have this very high PE ratio, you need a high growth rate. Sure, we will see in a minute why PE is not a good measure anyway, because it makes no sense if you bring in new big revenue or cash flow streams. But he says, well, you need these very high growth rates, which seems insane since both have huge TAMs, these two, Apple and Microsoft, unassailable brands, and highly predictable future cash flow streams. How is predictability important to determine the PE ratio or the market cap? That makes no sense, Gary. Predictability is something that you like and Wall Street analysts tend to like because it makes their life easier. Let me get something very straight. Predictability has nothing to do with reality and what will actually unfold. Just because something looks unpredictable to the observer, Gary Black, first of all, doesn't mean it's unpredictable for another observer who maybe knows more or is better in modeling this out. And second, it has nothing to do with what is actually going to happen and unfold in the future. So if there's an event coming, a very big event, let's say robo-taxi launch, let's say Optimus event, and predictability for a specific person A, let's call this person Gary Black, is very bad. So basically, Gary cannot see that happening, even though others might see it happening. The question if something is predictable for Gary Black is completely disconnected. It's not connected to any kind of reality other than his. So how can a lack of predictability for Gary Black be important for the absolute objective stock price for a stock? Not. The predictability is a function of us, our brains, and how we process the world, not of reality itself. So therefore, this makes no sense, because for people who actually can predict the future better for Tesla, all of that makes much more sense and it becomes more predictable. Okay, he continues. Tesla bulls who pretend they understand finance dismiss my argument that Tesla's valuation looks stretched by saying that 225 PE is irrelevant. Rule number one in investing is buy low, sell high. Okay, Gary, this is not about finance, this debate. It doesn't matter how much you understand finance as long as you have a base understanding of finance. This is about the future and how well you predict the future and how confident you are in predicting the future. It has nothing to do with finance. This is not about finance. This is about a judgment call about the future. And your judgment is there will be no robotaxi, no Optimus revenue, or at least nothing of significance. Whereas my argument is there will be massive, massive cash flows coming in latest by 2028. That is where we diverge. Our perspective on the stock and finance itself is not that different, right? If I would tell you my revenue streams and my EBITDA streams, and you would agree with them, the finance piece is the same. You come to the same conclusions as I do, but you do not have my model and you do not agree with my projections. That is the divergence, not a knowledge of finance. Knowledge of finance doesn't matter. What you are talking about here is a totally subjective, totally, in the eye of the beholder judgment call on PEs. I do not believe in PEs. Price earnings ratios don't matter to me. What matters to me are 10-year forward-looking discounted cash flows. That is the only thing how I value companies, and that forces me to predict these future cash flows and put them into a table, not a price earnings ratio. Let me explain for a second. If you have a price earnings ratio, it means you take the price, the stock price, and divide it by the earnings. For example, if you have stock price of 10, right, and your earnings are $1 per share, you have a PE of 10. But what if you have a company that has no earnings? It makes no money. Maybe it loses money. What is your valuation? What is your PE? Gary would say, in his logic, well, the PE is not just infinite, it's like negative. That makes no sense. You have to look at the company. It's like, well, it's negative now, but does it have a plan how it becomes very positive, like any startup, anyone who does innovation? And at that moment, the more you have something where innovation matters, the more PE goes out of the window. It makes no sense. And guess what Tesla is? It is a mega startup. It is a giant company that is now in the process of launching 2 revenue streams that are vastly larger than its entire current core business. So applying the PEs on the core business makes no sense, Gary. Okay, let's listen more to Gary. A stock's valuation is the present value of all future cash flows, discounted back at a risk-adjusted cost of capital. Debatable, but whatever. Plus net cash. Yes? Yes, Gary. Now we agree. One can then divide that estimated value by 2025 earnings, 2026 earnings, blah, 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 or any future earnings to calculate a stock's appropriate PE. Yes? To say that the PE doesn't matter is equivalent to saying one doesn't take valuation into consideration. No, that's not true. The PE is the price earnings ratio of this year. If it's a 1-year forward PE, then it's 1 year forward. If it's 2 year forward, then it's 2 year forward. But it's not a 10-year discounted cash flow. So you're contradicting yourself right there. You just said a stock's valuation is the present value of all future cash flows discounted back at a risk-adjusted cost of capital. What do you want with your PE? Okay, that would be like buying an apartment building and saying the current rent roll, expected future rent increases, and future expenses don't matter. Gary, you're not being logical here. You're conflating DCF and future cash flows with PE. It makes no sense what he's saying here, because that's exactly not what it is. PE is current or backwards looking, whereas discounted cash flow is forward looking. It's all stemming from Gary's base assumption that whatever earnings you have right now cannot change much in the future. They might be able to change 10% or 20% per year, but not more. That is fundamentally not the case when you talk about disruptive innovation that's coming into the market. That goes out of the equation. At the extreme, one can short a stock if it's bad business and the value is significantly below price, as we have done with Lucid and PSNY. What is that? I don't know. We can't see a situation where we would short Tesla. Okay. P is shorthand metric used by portfolio managers to size relative positions. If one only owns one stock, a metric like PE doesn't matter. Institutional portfolios typically contain 30 to 100 positions. Without these shorthand metric, PE versus long-term EPS growth, how does one with multiple positions size Tesla and NVDA versus Meta? Gary, the way you size these positions is by discounted cash flows. You just look at what is the price compared to what the price should be, the current discounted future cash flow value of that business, and then you can compare it. How much do you pay for that discounted future cash flow? That's how you should do it, not with PEs. Okay, let me jump right into something here, into another tab to show you that, and then we continue with this, okay? Hey, if you want to stay ahead of capital markets and the next Tesla moves, join us in Pioneerlands. Here we track Tesla, capital opportunities, AGI disruption, and politics. It's your critical information advantage in the age of AGI. It's free, and the link is in the description. Let's get back to the video. Here is a model, just to explain how I see that very differently, or not even differently. Gary is contradicting himself. He's saying half the right thing and half the wrong thing. So for example, what I did here is, this is a model that starts basically here with demand inputs, where I'm saying what is the install base of Optimus units, what's the robotaxi install base and fleet per year projected, right? And what is the core business, the core EV fleet size and core new EVs sold, right? So you have 0 in 2024 for those, and you have core fleet side of 7 million and 1.8 million new EVs sold in 2024. We know that, right? And then you're modeling first step, Gary, just to be on the same page. First, we model out what is going to happen here. I'm saying, well, in 2025, I say Optimus units, we will have, something around maybe 10,000 Optimus units. It doesn't even matter if it's 5,000 or 10,000, something, because they don't make much money at this point this year. The robotaxi fleet, right, is about 1,000 this year. It's very conservative. Next year, it goes to 100,000. It's less conservative. Then it goes to 750,000, then to 2 million, and so on and so forth. Because autonomy is going to disrupt everything. And in 2028, we see artificial superintelligence and AGI coming into the world. So the assumption that you do not have complete perfect autonomy by 2028 is ridiculous. And if you have perfect autonomy, Tesla is already proven to be able to deliver less than $1 cost per mile drives. And that means complete disruption of the entire auto market, because we will have also mass unemployment and all kinds of things happening in the next 2 years. White collar jobs are gone. Employment is going to implode. People will get poor. Unfortunately, a lot of people, they cannot afford cars anymore. They need to jump into more affordable transport. So we are not talking just about knocking out Uber, another stock that Gary holds, but we are talking about massive inroads of robotaxi into car ownership and so on and so forth. So you will have millions and millions and millions of people who need robotaxis by 2028. And Tesla is right there. It's a perfect storm of things. Okay, back to the valuation issue. So once you have modeled out these demand inputs and all these discussions that Gary has, they are short-circuited and short-sighted. You can't have these discussions about PEs and valuations. You first have a discussion about this assumption right here. That is the thing you need to talk about with Gary. And Gary should have much more discussions around that, because the rest is trivial. The whole modeling of EPS and PEs and DCF is all easy once you have that straight. And that's exactly where the divergence happened, where the people, the conventional Wall Street analysts, they say it's inconceivable for them that you have 4 million robotaxis in 2029. For me, it's inconceivable that you don't have 4 million or more in 2029, given the crazy stuff that's going to happen. So here's where the difference is. And then once you have these projections, right, of the actual demands, this is how you always start any model. You have to see the future correctly and triangulate how many Optimus robots are being sold, how many robotaxis are on the street, and what the core business does. Then you project this down here into all these revenue and EBITDA projections of the company, right? Once you have these numbers, it's easy to translate them back down into the actual revenue and EBITDA projections, right? So you know what the company, how much revenue will it make with that many robotaxis, with that many Optimus, and with that many EVs and energy business. How much EBITDA? What are the operating expenses? I have pretty conservative assumption here, and that helps me then model out the discounted cash flow, right? So the valuation model, market cap based on DCF. So here you basically project forward, given the EBITDAs and the net incomes, right? What is the actual discounted cash flow here? And then you go into, the actual market cap. And by doing that, you get to a certain fair market value of the future cash flows. And then you can compute your share prices here. Very simple. And my share prices for 2025 is $1,000. That is where the share should be. That is a fair future value of this discounted cash flow. There you have it. So that is that's very interesting. And then you can, from there, discuss what the PE is. And you see my PE is actually 500. My fair current year PE should be 500. And Gary complains about 180, because for his PEs, it's backward looking or current state looking, not forward looking. The 1 year forward PE is only 395 and the 2 year forward is 207. And as you see in 2026, and the share price should be at 1,700 in my opinion, you can then show that the 2 year forward PE, for example, goes down dramatically. Why? Because the cash flows go through the roof in that trajectory. And that is why you can pay extremely high PEs if you assume that the cash flows go exponentially through the roof in the coming years. Okay, that is what Gary overlooks. So let's go back to Gary and see what else he says. Now he's talking about next year's Tesla Wall Street earnings are now $1.93 per share. I think he means 2025 is now estimated $1.93 per share. 2026 is estimated $2.90. 2028 is 760. Okay, that's exactly what I'm talking about. If we go back, how does this compare with the reality I'm projecting? EPS 190, I actually agree. I completely agree. In 2026, 290, well, I'm actually saying 270. So I'm actually lower than Gary, right? But in 2028, Gary says 760. I'm saying 1920. That's where the rubber hits the road, right? So because then you have an exponential effect of robotaxi. So I'm talking about $19 per share earnings, whereas Gary says 7. That is very bad. And then it continues exponentially on my trajectory. That is why the discounted cash flow is so different. That is the problem that Gary has here. What else does he say? The EV business still comprised 72% of Tesla profits in 2025 Q1. Analysts typically look at PE relative to the future growth rate, which tend to degrade over time as success attracts competitors. This is a complete theory. Who knows? What are you talking about? Blah, 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 mode, patent. So where's your robotaxi situation? Where's your Optimus situation? This all refers back to the car business. That I have the core business at a steady growth rate of 15% per year, mostly because cars are going down in margins and energy is going up. So together they hit 15%, which is pretty conservative. But it's all about the new cash flows that you are not even considering, Gary. On 2025, 1 year forward, non-GAAP, blah, 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 180, 2 year, 120, 2029 for 5 year forward PE of 54. I'm pretty sure I'm more around like a 2 or something, or 5 for a 5 year forward PE. The 2025 PEs are extremely high relative to Tesla historically comparable forward PEs. No one cares about historically comparable forward PEs. As our focus go out to 2029 beyond, Tesla's forward growth rate will degrade as robotaxi and Optimus are included in the base. When an analyst opines about in PE, it's usually to assess the PE relative to the future growth rate, yes? And from that point forward, so a 2025 PE gets compared to the forward EPS growth rate from 2025 on. The 2026 PE gets compared to the EPS growth rate, blah, blah, blah. Exactly, Gary. So the core of the descent, the core of the divergence here is that your projections of the future diverge dramatically from mine. And they are diverging dramatically from anyone who knows anything about robotaxis or Optimus. Now we can discuss if this future is going to happen the way I predicted. I think it's insanely unlikely it does not unfold the way I predicted in terms of autonomy and timelines for autonomy and timelines for robots. The next question is, will it unfold for Tesla the way I predicted? But what other company can do it? There is no one who can do robotaxis, autonomous driving right now. There is no other company that can do it. Waymo is a joke, as we know. It's all like manually remote controlled and makes no sense. The robots will require things that only Tesla can do for now. The markets are multi-trillion-dollar market sizes. So what is Gary talking about? I think he just doesn't get the basics of that future projection. And therefore, I'm saying, Gary Black, you're wrong. We also have to consider that Gary, of course, owns a good chunk of Uber stock. And people say that might be a motivator to bash Tesla and sell it. I disagree. If Gary would understand and believe in Tesla the way we do over here, he would just sell Uber and buy more Tesla. So you can't argue that he owns Uber and therefore he's biased against Tesla. No, he believes in some weird future that is just a continuation of the present and does not involve any significant innovation, despite a massive wave of artificial superintelligence approaching, latest in 24 months, and Gary just doesn't see that future. And if there's one takeaway for a financial analyst that on Wall Street, unfortunately, no one seems to have understood yet, is that the core competency of a financial analyst is not to model out financial stuff, because that's trivial. ChatGPT can do that for you. No, the most important trait and quality and skill of a financial analyst is to predict the future accurately. The modeling is the easy part. The prediction is a little harder. So look out for people who can predict the future, because they will know where the stock prices go. I hope that was helpful. Now you know what I think about Gary's take on everything. I hope to see you very soon.